A man becomes wise when he can filter the signal from the noise, the truth from the lies, and the diamond from the dirt. That's what we do here every day, is teach a method where you can do that. What we talk about is trend following. It is the most important thing I think you can learn if you want to learn technical analysis or charting. Now, value investing is all well and fine. I'm all for that. But even when you're looking at buying a good company, why should you buy it when it's reaching a high and turning down? Think about this. When the tide goes out of a harbor, all the boats go down. No matter how nice they are, they all sink. Same thing happens when the ebbs and flows of the market take place. And what we do is we trend follow. And the most important thing we look for are the weekly vertical crossovers, like happened on the S&P 500 on the chart I'm looking at right now, back on the 8th of May, after we had the crossover going down when the whole COVID mess started. That week was the 28th of February. How long did the market go down? For a long time. Should you have taken those losses? Well, if you were reading our charts and you were practice trading, you would not had to have done so in your practice portfolio. I say practice because we're not a stock calling service. We're an education firm. We want you to practice with us. What does it cost you? 10 to 15 minutes a day. What are the benefits? Boundless. Think if you could, with accuracy, figure out when the market's going to go up for a long time or when it's going to go down for a long time. Not just the market, but individual ETFs. We're looking at the S&P 500, the Nasdaq 100, 20-year bonds, and gold. We chart these every day. 10 to 15 minutes is all we ask. Let's get to it. We see that the S&P 500 down a little bit for the day, 0.36%, the only thing down in our charts. But let's look at how the week is starting. We see that as the week starts, the prior week hit a high of $350.72. $351.30 is the high that we have reached so far this week. It is actually a higher high. It didn't close there, though. We'll see more of that when we get to the smaller chart. Price percent oscillators lost a little bit of its luster, not much. Derivative oscillators still heading up. Go to the 2-day chart, hone in a little closer. Now remember, the prior 2-day candle ended on Thursday, so the current candle represents Friday and Monday. And again, we look at that candle. Did it hit a higher high? Well, we look on the left-hand side of our chart, 151.30. The prior 2-day candle, 149.90. It did. Consequently, derivative oscillators going up. Price percent oscillator looks like it shaved off a little bit, maybe, but still going up nicely. Price is still nicely above. We're going to redraw that trend line a little bit since that candle has finished drawing. We want to keep our trend lines as close in time as we can, connecting 3 or more candles if possible. 2 candles being connected, you can always do that, but that doesn't give you a whole lot of a trend line. When you connect 3 candles or more, we like that. Now, we see prices above that 2-day trend line, well above the weekly. We go to the half day. What do we see there? Well, we can see where things are slowing down in their up movement. Look at that derivative oscillator. That is our leading indicator. It's a triple smooth version of the RSI. And what it basically shows you is price increasing over time. The price increases, are they increasing at a faster rate? And when that starts to slow, that's where you see a devolution of the derivative oscillator, the leading indicator. The price percent oscillator is our lagging indicator, but it is our best indicator we have found over time. And we can see where it also is losing a bit of energy. And again, we'll keep an eye on it, see it up in the morning and in the afternoon, but closing lower. So again, we'll keep our eye on things, keep a watch out for what's happening with the S&P with that little bit of down movement. Now, those of you who've been following us, you know that we had a 2-day recross back on August the 3rd. And again, things still moving up since then, jumping in point somewhere around the 326.50, we'll say 326.50 to a high of 351.30. Is that pretty decent? over a few weeks, I'd say, yeah, not even a month. That's pretty decent. That is the power of the crossovers. Now, the 2-day crossover is not a big a favorite of ours as the weekly vertical crossover, but again, it works many times. And of course, part of your job in training is to backtrack on the stocks and ETFs you're interested in following and see how accurate those 2-day recrosses are before you start relying on them for your practice trades. You may just want to stick with weekly vertical crossovers because again, when you find a good chart like the Nasdaq 100, the S&P 500, 20-year bonds and gold, this year we have had 13 weekly vertical crossovers. 12 of them have worked swimmingly. Now, let's see where the Qs is. Up for the day, 0.80%. We can see just glancing at that, reaching a higher high. Nice up candle, price percent oscillator climbing, derivative oscillator climbing. Go to the 2-day chart. We can see reaching a higher high, moving up above the weekly and the 2-day. That's good to see. Half-day chart. What do we see there? Up in the morning, further up in the afternoon, so things are climbing nice. When did we have that 2-day recross on the Qs? That was back on the 2-day candle ending Friday the 21st of August. And the jumping in point somewhere around the 278, 279 mark, up to a high of what? The high so far, 296.75, and that is in 6 days. Pretty nice, isn't it? Beautiful. So we like to see that. What do we see on the half-day chart? The price percent oscillator flattening out a little bit, again up in the morning. Derivative oscillator losing some momentum further up in the afternoon. So that's where we are on the 2 stock indexes that we follow. Like we said, the S&P 500 and the Qs, which is the Nasdaq 100, the tech stocks. Let's move on to 20-year bonds. Now, they are up for the day 0.66%. When we look at our Heikin Ashi candlesticks, we can see that even though it was an up day, how's the week starting off? We can see that the Heikin Ashi, I'm told, means average pace in Japanese. What do we see there? Well, we see that the week is starting off down, not hitting the low it had in the prior week. That is as far as our Heikin Ashi candlestick goes, even though, yes, it was an up day, but the average pace of the Heikin Ashi candlesticks, and I tell you what I'm going to do. I do this fairly often. For those of you who are new, I'm going to put the Heikin Ashi training at the end of today's video for you. We do have a special training for the folks that subscribe. If you're not a subscriber, you want to get our special daily trainings, you need to go to chartingwealth.com, put in your name, email address. That list is never spammed or shared. We will make sure you get our daily trainings to date, as no one wants you to have our knowledge. Why? Because it works out great for Wall Street, for you to believe that you can't follow trends. Again, dollar cost averaging works out great if you leave your money in those mutual funds, in those ETFs as they go up, down, sideways. That's great. We want you to practice trade to see if indeed that is not true, that you can actually follow trends. Again, practice to show yourself approved. I have a feeling that if you stick with us 10 to 15 minutes a day for a while, you're going to figure out that day in and day out, you can get pretty good, if not really good at this. And you know what? A little knowledge goes a long, long way. So everybody who is a subscriber, get that training. If you're not a subscriber, become one. For everybody, I'm putting at the end of today's video the Heikin Ashi candlestick training. So what are the Heikin Ashi candlesticks showing us? They're showing us that there, as far as the average pace goes, is down. We see the derivative oscillator gaining downward momentum. Price percent oscillator still heading down. Looks like it's lost a little bit of that downward push, but still down is on the plate. All things being equal, the market tends to move in the direction of the largest chart. What do we see going on our 2-day chart? We're going to redraw the 2-day trend line with these latest 2-day candles, the two 2-day candles. What do we see there? Well, again, we see price moving down, the latest 2-day candle representing Friday and Monday. Price percent oscillator losing some of that downward momentum. You can see where it's not quite going down at the same angle, shaving that off a little bit. And the derivative oscillator losing some downward momentum. We go to the half-day chart. That's where we see where things hit the bottom on Friday afternoon and then up some in the morning on Monday, pushing through the 4-hour, or the half-day rather, trend line, and up a little more in the afternoon. So we'll keep our eye on things. Now again, remember, we're continuing to watch, see what there is to see. We had that. Again, this was another one of our 2-day recrosses going down. The weekly was already down. The 2-day crossed over going down. We had our jumping in point somewhere around the 168.50 mark or so. We'll just say 168 mark. What is the low we have hit so far on that 2-day chart? 160 over the course of 2, 4, 6, 8, 10, 12, 14 days. So again, that's what we know. You might say, why would anybody want to buy something that loses money? Well, there are inverse ETFs that you can practice trade, TBF being one of them. It is the short of the bond fund, and it goes up when bonds go down. Isn't that interesting? Other thing I'm going to put in at the end of today's video is I'm going to put in the inverse fund trading, how to successfully practice trade when markets are crashing. Because not only is there an inverse fund to bonds, there's an inverse fund to the S&P 500, SH. There's another one for you. In fact, as the underlying asset, which is the S&P 500, is going up, SH is going down, right? Well, what happened when we had the crash, the COVID crash, starting back in February? Look at what happened to SH. It rocketed up, and it's been going down as the market's been recovering. Isn't that interesting? So again, as Jim Cramer likes to say, there's always a bull market somewhere. Inverse funds can be your bull market when the market's crashing. So can options. Puts are a way to short the market. For those of you interested in options, we have a 3-part option series available to our Patreon supporters. If you want to support the channel and our work, we would so appreciate it. Follow the link in the show notes to our Patreon page and support us there. Just $1 a day, $30 a month. You get all that special training plus the live question and answer call-in session. We want to have you with us. So don't forget, that starts again. We've got another one coming up at the beginning of September, and I sure hope that all of our Patreon members are planning on being with us. We've got lots of great information to share with you, and we love getting your questions, your concerns, your problems. We like to address all of those in those live call-in sessions. Now let's get to our last chart for the day. Gold up 0.24%. What do we see happening? Well, friends, when we tune into gold, we can see where gold peaked back on the beginning, I guess that first full week in August. Gold peaked and then sort of slid down, and looks like so far the first day of this latest 2-day, or this latest weekly chart, it's trying to gain a little momentum. Now that can change. It's just the first day of a 5-day candle. We can see the price percent oscillator still heading down, derivative oscillator still losing momentum, but that's a green up box. Again, that reflects some of the up movement during the day. We look at that latest 2-day candle. That also shows us, we can see the price percent oscillator flattening in its down move, derivative oscillator losing downward momentum. It had been gaining it up until this week, pushing through the 2-day trend line. Now that's interesting. So we'll watch and see. Price percent oscillators still negative on the 2-day, still negative on the weekly. So we'll continue to watch, but what is it we're looking for? Is gold going to cross back over, going up? Are we going to have a 2-day recross? Since the weekly's still heading up, that would be an opportunity to jump back in to gold, going long on gold. Long means you're expecting the price to go up. Short means you're expecting it to go down. We don't know yet. It's in flux. We're going to watch, wait and see. What do we see on the half-day chart? It crossed over going up back on Friday morning and has continued to try to move up. Again, not going much higher than the high that it reached on Friday, right? Staying about that same area, but we'll continue to watch and see. We're continuing to keep our eyes out for a potential two-day recross going up on gold. We'll let you know when that happens and when you need to be particularly alert for it. It can't happen until at least Wednesday. Why? Because we don't call a candle until it closes, and since we finished the latest two-day candle on Monday, the next one won't close until Wednesday. So you have at least until then to get your act together to potentially jump into a two-day recross if we have lots of up movement in gold. So we'll see if that practice trade makes itself available. Hey, sent out a bunch of books today. If you don't have the second edition of Charting Your Way to Wealth, you need it. We've got an autographed copy waiting for you. You want to support us here at the channel. Besides being a Patreon supporter, getting all those 3 videos, that special training we have on options, the Charting Wealth Way. You can also support us by buying our book. Follow the link in your show notes. God bless, my friends. All the best from the whole team at Charting Wealth World Headquarters.